Welcome to the deep dive. Today we're digging into Gravita India Ltd. They're a global recycling player, handling lead, aluminum, plastic, rubber, quite a mix.
Indeed. And we've got their latest numbers, Q4, and the full fiscal year ending March 2025.
Yep, we're looking at their investor presentation, board meeting notes, the audited financials, the whole lot.
Our mission, as always, is to sort of pull out the key stuff from all this data.
Exactly. Give you, the learner, a clear view of Gravita's performance and, well, where they might be heading.
Right. Cut through the noise and get to the core story.
Okay, let's start with the big picture. Financials. Q4 FY25 revenue. Consolidated, it was over 27.07 crore.
Which is a pretty
Wow.
solid number.
Yeah.
If you look at the full year, the presentation flags, 22% revenue growth year on year.
And crucially, volume growth was strong too, right? About 20%.
Exactly. That's important because it shows they're actually processing and selling more material. It's not just, higher metal prices doing the work.
Makes sense. What about the bottom line? Profit.
Well, for Q4 FY25, consolidated net profit was 94.92 crore. And the full year, a very healthy euro 312.39 crore.
And the growth there, the presentation mentioned 31% year-on-year growth in PAT.
That's right. 31% jump in profit after tax. Pretty significant improvement.
So FY25 sounds like a banner year for them overall.
Absolutely. The management commentary highlights it. Highest ever revenue, highest EBITDA, highest PAT. A record year across the board.
And that EBITDA figure for Q4? Earnings before interest, taxes, appreciation, amortization.
Yeah, after adjusting for currency and metal price swings, it came in at 108.52 crore for Q4.
Yeah.
Gives a good sense of their operational earnings power.
Now, something that really caught my eye was this focus on value-added products.
Yes, that's key.
Management said 46% of FY25 revenue came from these. That seems high. Or, well, significant anyway.
It is significant, and it's a strategic focus. These value-added products, basically, they involve more processing, more refinement.
Which means higher margins, presumably.
Yeah, precisely. You can command better prices. So getting almost half their revenue from this stream is a big driver for their improved profitability. It's smart.
And related to sourcing, they increased domestic scrap sourcing by 60%.
Yes, another interesting point from the commentary. Sourcing more domestically could, make their supply chain more stable, maybe even lower costs compared to the volatility of international scrap markets.
Okay, let's look at the different business segments. Do we know which one's the biggest contributor?
We don't have a precise Q4 revenue breakdown per segment easily available, but we do have the volumes.
Right. Q4 FY25 volumes. Lead was about 20,500 metric tons.
20,466. Aluminum was just under 20,000. 19,836 tons. And plastics, around 9,900 tons.
And overall volumes, as we said, up 20% year on year. So growth across the board, it seems.
Seems that way. And remember, Gravita isn't just an India story.
No, definitely not. That overseas revenue figure for FY25, 68%. That's huge.
It really is. It underscores how global their operations are now. Asia, Africa, Middle East, Europe, the Americas. They're properly diversified geographically.
So while we might not have the exact Q4 export split, that full year number tells a clear story about their international strength.
Absolutely. It's a core part of their business model.
Okay, shifting gears a bit. Looking forward, Vision 2029 sounds grand.
It is ambitious, no doubt about it. They've laid out some big targets.
Like what? I saw something about volume key GR.
Yeah, aiming for over 25% compound annual growth rate in volumes, plus over 35% growth in profitability.
Wow. And return on invested capital, ROIC, over 25% too.
That's the goal, along with getting over half their revenue from those value-added products we talked about.
And getting more from non-lead businesses. Over 30% target there.
Correct. That points to significant diversification. They're actively targeting new recycling areas.
Which ones specifically?
They mentioned lithium-ion batteries, steel, rubber, and paper, moving beyond their traditional base.
That diversification makes sense.
Yeah.
Reduces reliance on, say, just lead prices.
Exactly. Opens up potentially high-growth markets, especially something like lithium-ion battery recycling. That could be massive down the line.
Now, to achieve all this, they need capacity. Big CapEx plans, right?
Oh, yeah. They're targeting over 700,000 metric tons per year capacity by FY28.
And the investment needed, over 1,500 crore.
That's the plan. 1,500 plus crore, and they're already spending deployed 402 crore
Yeah.
just in FY25.
So the investment is happening now. They're putting their money where their mouth is, so to speak.
It certainly looks that way. It shows confidence in the market and their strategy.
And that ROIC figure,
Yeah.
they actually hit 27% pre-tax in FY25, right? So already above their target.
They did, which is impressive. They put it down to good industry dynamics, better working capital management.
Working capital being the money tied up day to day.
Right. Less cash tied up there frees it up for other things. Plus, the demand-supply situation and, again, those value-added products helping margins and returns.
It suggests their investments are paying off efficiently.
Seems to be the case. And that links back to their sourcing network, too.
Ah, the global reach and the collection points within India.
Yep. Having operations across continents, plus those 33 owned yards and, was it 1,900 plus touch points?
That's a lot of collection points. They gathered over 287,000 metric tons of scrap.
That network is a huge asset. It gives them better access to raw materials, maybe better pricing power, more control. It's a real competitive edge.
And their strategy seems to be establish scrap collection first, then build processing capacity.
That appears to be the model, yes. Secure the input, understand the market, then scale up the value addition. Seems sensible.
What about the balance sheet health, debt levels?
We don't have the debt-to-equity ratio immediately here,
Really?
but their capital allocation policy gives us clues about their discipline.
Right, you mentioned that. Max 3-year payback on new projects.
Yes, maximum 3 years. Plus, they target at least 8 times asset turnover.
So, generating revenue efficiently from their assets.
Exactly. And that minimum 25% ROIC target for any new project. It suggests they're very focused on making sure investments generate strong returns quickly.
Which is good for long-term financial health.
Definitely a positive sign for investors.
Speaking of investors, shareholder returns. There was a dividend announcement.
There was. The board declared an interim dividend of 6.35 per share for the next fiscal year, FY26.
Okay, payable soon then. Record date was early May.
Correct. Record date May 8th, 2025, with payment by May 31st. Shows confidence in continued earnings.
And the earnings per share, EPS, for the year just ended, FY25.
Consolidated EPS came in at 45.11. Basically, the profit earned per share outstanding, a solid figure reflecting that record profit year.
So pulling it all together, the management commentary sounds pretty upbeat.
Very much so. They emphasize the strong FY25 performance and reiterate their confidence in hitting those Vision 2029 goals.
And the strategic priorities seem clear. Shareholder value, profitable growth, careful capital use.
And sustainability, too. They mentioned specific targets for reducing energy consumption by 10% plus and using 30% plus renewable power.
Right, the ESG aspect. Their whole business is recycling, but they're also focusing on how they operate.
Exactly. The themes building a green world through recycling and towards clean, green, and sustainable future aren't just slogans. They align with their core operations and broader ESG commitments. That's increasingly important.
Okay, now, we do need to touch upon the auditor's report. There was a qualification, wasn't there?
Yes, that's important to note. Both standalone and consolidated audit reports carry a qualified opinion.
What was the issue exactly? Something about employee benefits and treasury shares.
It relates back to FY24, actually. It concerned the accounting treatment of employee benefit expenses linked to a gain on the sale of some treasury shares held by their employee welfare trust.
So the auditors felt it should have been accounted for differently.
Essentially, yes. They believe a specific accounting standard should have been applied, which wasn't. The main impact they highlight is that it affects the direct comparability of certain expense figures between FY24 and FY25.
But management disagrees.
Correct. Their view, as stated in the Statement on Impact of Audit Qualifications, is that their accounting was appropriate. They argue the trust is independent, and they didn't control those funds directly, so the standard the auditor cited didn't apply in this specific situation.
Okay, so there's a difference in interpretation on that specific accounting point related to a prior year transaction.
Precisely. It's a technical accounting matter. While it's flagged by the auditors and affects strict comparability on that one-line item, it doesn't seem to fundamentally change the picture of strong operational performance in FY25. The record revenues and profits still stand.
Right. So boiling it all down for you, the learner, what are the main takeaways here?
Well, first, FY25 was a standout year for Gravita. Record revenue, record EBITDA, record profit. Strong growth across the board.
Second, their Vision 2029 is ambitious, but looks strategically sound, focusing on diversification, new materials like lithium, and boosting value-added products.
Third, their global reach and that extensive scrap collection network are major strengths. real competitive advantages.
Fourth, yes, there's that audit qualification, but it relates to a specific prior year accounting issue and doesn't seem to negate the underlying business strength shown in the FY25 results.
So overall, the picture is of a company performing well, with significant growth potential in the critical recycling sector.
Yeah, I think this deep dive gives a pretty good handle on where Gravita is and where it's aiming to go based on these latest reports.
Which leads to a final thought, perhaps. Considering these ambitious plans, especially the move into things like lithium-ion recycling, how might Gravita's role in the whole circular economy change over the next few years?
Good question. And what challenges or maybe unexpected opportunities could pop up as they push into these newer recycling verticals?
Something to mull over. Of course, if you want every last detail, the source documents we used are the place to go.
Definitely. Thanks for joining us on this deep dive into Gravita India.